Welcome back. My name is Chris Gosselin from Australian Fund Monitors. Following today's decision by the Reserve Bank of Australia to keep the cash rate on hold at 3.85%, I'm joined once again by Nicholas Chaplin and Renny Ellis, both of whom correctly anticipated the outcome of last week's discussion, going against the grain of most economists and the money market. Gentlemen, congratulations, first of all, on getting it correct.
Thank you,
At its post-meeting statement, the RBA reiterated that the outlook remains uncertain, a phrase that's now appeared in every statement since late last year. They also reaffirmed that inflation and full employment remain the board's priority. With that in mind, we're here to unpack the RBA's decision, the market's response, maybe some of the journalists at the media conference questions, and most importantly, what might lie ahead for monetary policy in the second half of the year. Gentlemen, can we start with you, Nicholas? Let's start with your initial reaction. Was there anything in the statement that surprised you, or did the RBA play it straight down the line?
No, there wasn't really anything in the statement that surprised me. It was a reiteration, if you like, of the comments that came 6 weeks ago on May 20, which was after the last drop of 25 basis points. The governor was still stating quite a lot of positives. The private domestic demand appears to have been recovering gradually. Real household incomes have picked up. There's been an easing in some measures of financial stress. We've still got a tight labour market. Businesses are finding hard to employ the right people. The unemployment rate's at 4.1. And if you think about, we spoke earlier this week about the lag effect in some of this monetary policy easing that's been going on. She mentioned that. So it was good to hear this. It was difficult to understand why the banks have been suggesting 3 and sometimes 4 rate drops this year when the RBA has a mandate to deliver 2 things fundamentally among some broader themes: price stability, so that's keeping inflation checked, and full employment. Full employment is, and I think, Renny, you said this earlier in the week, it's been achieved at the moment when you consider things. The cash rate at 3.85 is historically actually quite low. So when you've got unemployment at 4.1, effectively full employment, and that price stability has or largely been delivered, I think they want to wait. And that was really the theme of the discussion post the announcement of keeping rates held at 3.85. They want to wait and watch more data, which tells you that what are you waiting for? Perhaps the media will read that as, well, then we'll get a rate drop. But effectively, you've got an RBA mandate that's being delivered at the moment. So I wasn't surprised at all, Chris, no.
Thanks, Nick. Renny, turning to you, markets were largely pricing in a cut, in spite of the fact that both you and Nick said that if you were in Michelle Bullock's shoes, you wouldn't cut. There's been some adjustment post-announcement. What have you made of the market's reaction so far, either in bonds, equities, or the currency, or is it too early to tell?
Well, we won't see the bank bill swap rate numbers until tomorrow, but already we've seen the 3-year bond up 12 basis points to 342, the 5-year up 10 to 370, and the 3.7, and the 10-year up 9 to 4.27. A reversal of that. The market's still pricing 21 basis point cut at the August meeting and an end of year official rate number of 3.22. And as Nick said, I think that's very wrong of the market now. That 3.22 is pricing quite a few cuts. Just don't see those happening for all those reasons that Nick outlined there. The other thing apart from, remember, we've got an equity market at a record high. We've got credit margins at very tight levels, and we've got a steepening bond benchmark yield curve. These are all telling us that the economy is in good shape and not about a need of a monetary stimulus. But the other thing is that the Aussie dollar has been stronger. It's strengthened over the day today as well, and that's telling us again that the economy is in good shape, not in need of a rate cut. So the market signals back up the economics that Nick was talking about.
Oh, I think that's a good point. And I think Michelle Bullock was at pains to say that we're in pretty good shape. I think she said if you'd gone back a year or two and suggested that this is where we would be now, you would have been laughed out of town. They're not the words she used, but she was much more central bankerish on that. But the phrase, the outlook remains uncertain, was something certainly in the media statement and her comments, and the whole sort of theme of her media conference was there's still some uncertainty out there. It was not a question of direction, but it's a question of timing.
Well, Chris, can I just say, this is not, to be fair, this is not about the RBA in Australia. This is welcome to Trump 2.0. We just don't know what sort of policies are going to come out of the White House at the moment. And we wake up every morning not knowing, and they have a dramatic effect. I mean, just this week, there's talk about, quite big tariff increases on some of their biggest trading partners. I mean, this is a difficult period. So when you talk about uncertainty, I think most of it is stemming from the Trump White House at the moment. When it comes to Australia, I mean, it's going to take a lot to move our unemployment rate by 50 basis points, which is indicative of a recession. It would take an awful lot. It's been very stable around these levels for a long time. And we have got expansionary budgets at both state and federal levels still. I don't see a lot of uncertainty out there in the Australian economy.
Nick, how do you interpret the RBA's emphasis on full employment? Are they signalling patience or laying the groundwork for cuts later in the year?
Well, I think that's simply their mandate, and Michelle Bullock has quoted that quite a bit in recent times publicly. And as Renny says, the stability of it has been quite amazing. 4.1, we saw high threes for quite a while over the last 2 years, but between 3.7 and 4.1, really for 2 years, it's remarkable stability. And when I think back, when I was hearing calls by the commercial banks in Australia for 3 or 4 rate drops this year, and it was already mid-year, and we'd had one in February, and they were calling for 3 more. I think we may have mentioned this earlier in the week in our discussion, but this doesn't feel like cycles that I've seen in even before I was working in the early 80s, or say 1991, 92, when there were real recessions, redundancies left, right and centre. It was an ugly world. Admittedly, it was that long ago, but we just don't have that situation at the moment. We've got a scenario where employers are just unable to find appropriate workers for their businesses to expand. Interestingly, she said that because of this, these same businesses were reporting that it's difficult for them to pass on cost increases that they've received. So to some extent, it was constraining inflation from being really shown within those businesses. But that was a factor coming out of strong employment. So I don't know whether these are comments that are sort of jawboning what she might like to see in the future. I think it's just really stating a fact. And to Rennie's point, very, very stable. And that's a large part of what the RBA has to do. The other part being control prices, make sure they're not fluctuating left, right and centre. And that's been done very well. It's now under control. So it's arguable now that the RBA has actually reached a point of neutrality instead of, oh, good, we've got the 2 main mandates that we meant to do exactly where we want them. Now let's drop rates. That's easing monetary policy rather than neutrality. So I'm of the view that she could very well sit here for a while.
Just add to that, Nick. We'd have to see, I think, and I agree with that, but I just add that we'd have to see an external shock of some kind to lower rates from here. And we need a reason to lower rates. And yes. That's being external. We don't know it until we're hit with it. Looking
ahead, when do you think the RBA might realistically begin cutting rates? Is it Q4, or are we looking into 2026?
Well, they are really looking for that. Let's watch the lag effect of easing that's already occurred. There was some information that came out not long before the 230 decision that was showing, again, more signs of economic strength in Australia. So they will now use the next period of time, number of weeks, to look at the lag of the effect of the May 20 reduction. And as I say, we may not see that in reality for some time yet, Chris. That would be my view.
So if the RBA does remain on hold into next year, what are the implications for investors, especially in fixed income and rate-sensitive sectors?
Well, I think those, just quickly, sorry, Renny, I'll just quickly say, I think those that have got overly set in duration may be in for a little bit of pain, certainly short to medium term, because there's been a big buy-in to what was seen as a certain rate reduction. I don't know whether we've seen huge moves as yet, but there's definitely been moves in fixed rate bonds this afternoon.
I'd just add to that, Nick and Chris, to say the 5 to 10 year part of the curve is largely determined by global markets. So we're hostage to what the outcomes are in the United States and maybe in Europe and the UK too. And the outlook there does not look good for duration. The average fixed duration fund out there has a duration around 4.5 to 5.5 area. So that they are going to be hit by what the external impacts. Domestically, yeah, we could see our curve flatten a bit here. That we've seen that already a little bit this afternoon, and then remain a little bit flatter maybe over the next 6 to 12 months. When we look at the data, a bit hopefully like the RBA does too, we're looking as a fund manager, we're looking 6 to 9 months ahead to in the hard data to predict what's going to occur. So the outlook is for rates not to change here, and floating rate bonds to outperform, given the strong carry at the moment, to outperform the sector.
So just finally, what would you be watching most closely over the next 2 or 3 months? Is it labour data, US Fed moves, or something else entirely?
I don't think the Federal Reserve is going to move. I am watching the Trump tariff outcomes very closely. I watch the Aussie dollar very closely. If the US dollar continues to weaken and the Aussie dollar globally continues to rise, then goods inflation here will fall. That will have it'll have an impact, but the actual impact won't be as great as it might have been a few years ago, because services inflation is very strong here in Australia now, and it hasn't weakened at all. So I am watching the services inflation very closely. And then when we talk about external shocks, our main concern really is China. And we have to watch the data coming out of China very closely. We've seen them pull back from buying our iron ore recently, and the iron ore price fell. That's an area where we have to keep a close eye.
I'd agree with that, Renny. And I think again, some small specks of news coming out of China were slightly more positive in recent days, but it's a long haul to watch that. But that's our major trading partner. That's where we're going to see the influences on Australia, and particularly on the Australian dollar and all the carry that you get from that. It also influences probably one of the things I mentioned earlier in the week, Chris, which is the GDP outcome. Just watching that very carefully on the basis that the March quarter was 0.2%, even though the annual number for the 12 months to that point was 1.3, which is more of a recent historic sort of trend for Australia. But if that 0.2 continued, or indeed got a little bit worse, that's on the back of my mind more than anything else at the moment.
Thank you, gentlemen. So we'll just wrap it up there. So from Nick Chaplin and Renny Ellis, Nick from Seed Funds Management, Renny from Arculus Funds Management, Thank you for your time, and congratulations again on getting your prediction right. We'll look forward to speaking to you again next time.
Thanks, Chris.
Thank you, Chris.